Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. After my last article that I posted on 15 fairly valued high-quality dividend growth stocks, I had several people ask that I cover IBM. And I've written about IBM in the past, which I talk about in the written portion associated with this video. But I've been an owner of IBM primarily for the dividend income. So let's look at a couple of quick things about the company. It's currently trading at a blended PE ratio under 10, 9.5, offers a 4.8% dividend yield. Its operating earnings growth has averaged 6.8% going back to 1999. However, I do want you to look at this. All I have on the graph right now are operating earnings per share. And I want you to see the company had a couple of down years through the recession of 2001. They went through the recession of 2008 as if it wasn't even there. They had really excellent earnings growth during that time. But coming into 2013, as we've kind of gone into I'll call it a technological revolution, if you will, IBM has found themselves a little bit behind the curve, but they're also working on fixing that. Nevertheless, they had 3 years in a row of down earnings, and then more recently, earnings growth has been very anemic, averaging 2% in 2017, estimated to be flat this year, and only grow by 1% next year, and then maybe expectations for 4% the following year. Now, when I put monthly closing stock prices on the graph, we see some very interesting valuation levels here. Number one, we see how the company was very overvalued like most tech stocks were back in 1999 and 2000. But we also see a period of time where earnings growth was really excellent up through again, 2013. We had almost 11% growth. And then once the company became fairly valued, we had really excellent rates of return on IBM. Even though it was undervalued here, if I run it from there, we had just under 12% a year annualized rate of return. But then as the earnings have begun to falter here, and IBM has kind of got behind the technology curve, we'll call it, we've seen the stock price drop precipitously. Now, dividend income has been a different story. This is the plotting of the company's dividends since 1999. And the area below that is a dividend payout ratio. And there's two things I want you to see that's happened here. Number one is you can see graphically that the dividend payout ratio was very low during the growth phase, and the payout ratio has increased as the company has become less of a growth stock, more of a pure dividend stock. So if we look at that by the numbers, we've had a 13%, 11%, 15% dividend payout ratios. That's increased into the 20% range for all these years. And then more recently, it's gone up to 30. And then the last couple of years, they've been paying out about 40% of their dividends. So we can see that very nicely on the graph here. Their payout ratio has increased dramatically. And later in the video, I'll talk about share buybacks. Those have been two things that have given IBM some investment allure, in my opinion. Anyway, the company's A+ rated. It's a $119 billion market cap. But in addition to earnings, I also want you to notice that gross sales, gross sales have fallen from over almost $107 billion in 2011 to about $79 billion last year. But I'm going to talk about shares outstanding. The company's been buying back their shares during this undervalued period, or I'll call it decade, rather aggressively since 2007. So we've got basically a company that's been buying back shares and paying a really nice dividend income. So this is the dividends after they've been paid out to the shareholders. So we can see the income side of this investment has been very attractive. If I look at it going back to 1999, they've outperformed the S&P 500 on the dividend. They've underperformed it on total rate of return and capital appreciation. Now I shorten the time frame a little bit where I start getting into slightly higher payout ratios here. Then we see that the dividend advantage begins to increase. It went $10,000 in 2005 would have thrown off $5,000 in dividends versus $3,200 for the S&P 500. Let me chop a few more years off here where I get into even higher dividend payout ratios. And now all of a sudden you see that dividend advantage is pretty much even with the S&P 500. But as it sits right now, currently, the company is offering a 4.8% dividend yield. Now I want to look at historical dividend yields as a valuation reference. So I'm going to go ahead and back up the graph a little bit and look at historical dividend yields. And they came into the end of last year with the highest historical dividend yield that they've offered in some time. This was their year-end dividend yield of 3.8. Back during the Great Recession, when the valuation got real low, their dividend yield was only 2.3. But again, I want you to notice the rising payout ratio. We're now a full percentage point above this at 4.8. So this is the highest dividend yield that the company's offered in quite some time. So what this means is at this point, I clearly see, and I've shown that we've got weak earnings and we have weak sales on a gross basis. So let's look at some areas that really protect the dividend and cover the dividend. So I'm going to switch here to operating cash flow from operating earnings. Now, people have asked me, when I look at operating cash flow, I'm not really too concerned about using it as a valuation reference, although in some cases it can be quite effective. What I'm really interested in is trying to determine whether or not the operating cash flows are adequate enough to cover the dividend. And first of all, I want you to notice that operating cash flows have been significantly stronger than what we saw with adjusted operating earnings prior to that. So the company is generating ample cash flows. Now this is a per share number, which will become important. But even more to the point, if I look at free cash flow, which to me is, that's the cash flow left over after what they spend to run the business, IBM has been covering their dividend with free cash flow. So I personally, even though the company's going through some operating difficulties from a bottom line point of view and a sales point of view, the company is covering their dividend quite nicely here. And I feel that that is one of the real allures, or the only real allure maybe at this point in time, for the short run, is the high dividend yield. Longer term, it all depends on whether the company meets their strategic imperatives or not. Now, forecast for free cash flow growth going forward is relatively low but steady, and I think that's the key. And free cash flow should continue to support the dividend. Now, I want to go into EBITDA, or earnings before interest, taxes, and depreciation. I want to look at this from a valuation point of view, because what you'll see here is a very high correlation with IBM's stock price and their EBITDA, and that includes going through these years where the earnings have fallen. And I want you to notice when the price gets above what I'll call a normal price to EBITDA over this time frame of 7.8, it moves back into alignment, and when it's fallen below that normal price to EBITDA, like it did here, it gets back into alignment and even sometimes overshoots it. Now recently, even with this weak price, we've seen the stock now is trading at 6.6 times EBITDA, and EBITDA is expected to resume growing again in the next couple of years. So if I was looking at a normal price to EBITDA of 7.8 or 8.6 like we're looking at here, we can see the opportunity that if the market ever decided to start valuing the stock more reasonably, you could have very substantial rates of return. If I look at the normal multiple, the normal multiple EBITDA would still give me double-digit rates of return. So that possibility certainly exists. But I do believe it's going to take more than the next couple of years for that to happen. I don't see IBM being a great capital appreciation stock, but I do see IBM being a very solid dividend payer with solid dividend coverage. But let's look a little more under the hood. So in order to do that, I'm going to go to fund graphs, or financial underlying numbers, and I'm going to go into the in millions graph, or the gross numbers. And I'm going to start by looking at total revenues. I've already done that earlier, but we've obviously had this decrease in total revenues. That's clear, and I've already explained that. But now let's look at that, as I talk about in the written portion of the article, on a per share basis, because as an individual shareholder, I'm interested in what happens to my shares more than I am actually the gross shares. So when I look at IBM's revenue per shares, and I'll slow this down a little bit, even going back to 2007, I see actual growth in revenues. We've had a little drop off from 2011, 12, and 13, but we're starting to see modest increase, $83 billion here, we're seeing 83.5 here, and we're saying 84 here. And then if I look at this, these are quarters, this would be the fourth quarter or the year-end quarter, and you can see that the company's been maintaining its revenues here more recently on a per share basis. Now, the reason for that is very simple. If I go back to the in millions graph and look at common shares outstanding, which I put a graphic in the written portion of the article, you can clearly see that IBM has been buying their shares aggressively back at a rate of about 4% a year. They've gone from 1.39 billion to 922 million shares. And as a result, even though the gross revenues have been dropping dramatically, because they've been reducing their shares as a shareholder, I'm starting to see revenue growth, and I'm also seeing good cash flow. If I look a little more granular look at their operating cash flows here, I can see that operating cash flows per share now, this is the per share graph, have actually been steadily growing, which again is very consistent with the dividends paid per share. The dividends paid per share have also been rising rising very dramatically, averaging almost 15% growth from 2007 through 2017. And this is my primary interest in investing in IBM at this juncture. Now, looking a little deeper into the company also from a standpoint of some of their operating results, I want to go into our percentage graph here and look at gross and net profit margins. Now, the company is maintaining positive net margins. In 2017, they averaged 7.27%, but that was down sharply from 14%. So as I pointed out, there are some issues with this company. Likewise, we see some significant drop in a return on equity, although they're still generating a 32% return on equity. If I look at return on invested capital, we see about 11 to 12% returns on invested capital. And then if I look at returns on assets here, we see about a 6% return on assets. So the company is still profitable. It is still generating returns, but it's clearly a company in transition. Nevertheless, when I look at IBM as a long-term investment, I'm primarily interested in this dividend growth. This has been the real allure of the company, the fact that they've been continuously increasing their dividend, and more importantly, that their dividend is currently available at just under 5% per annum. So I think the company has tremendous resources. I'm willing to hold this company for a long time, as I already have, and I think eventually I could get rewarded with some great growth potential going forward if and when the company ever turns itself around. They're doing everything they can to do that, but I'm not willing to count this company out yet. It has enormous resources. It's a massive company. It's fully entrenched in technology through corporations large and small throughout the world, public and private. And I think their legacy business is not necessarily growing, but it does give them, in essence, a very stickiness, because most people aren't going to leave the business. So will IBM be successful in the future? The jury's out, but I love it for the dividend, and I'll continue to own it for the income creation that it's been generating for. This has been Chuck Harnwell saying I hope you enjoyed this video. I want to thank you for listening. If you're interested in learning more about fast graphs, you can email us at the email on this page or call us at the phone number. We'd be delighted to help you. Thanks again for watching.